Today we're going to talk about Chapter 12, which has to do with corporations and how they generate large sums of money. And they do that by selling stock. So this whole chapter is really about understanding the corporation, how I sell stock, how I determine how I sell stock, how I determine how I pay dividends, and how to journalize it. So let's just get started a little bit about characteristics of a corporation. Corporations are a separate business from their owner. So they can incur debt, they can enter into contracts, they can do anything. The corporation itself can do anything they want to. When they need to raise large amounts of money or capital, they sell stock. And by buying stock of a company, you actually become a stockholder. So a stockholder is someone who actually purchases shares of a corporation. Now, you cannot buy everybody's stock because if a corporation is privately held, then you will not be able to buy their stock. So in order to buy a company's stock, they have to be publicly traded. So any companies that are publicly traded on the stock exchange, you can purchase their stock. The other corporations are called privately held corporations, and you cannot buy their stock. And that's a whole nother topic about how can a company go from a privately held to a publicly traded. That's a whole nother lecture. So let's talk about what stockholders can do and can't do. Remember, you buy a share of Nike stock or Home Depot stock, you actually own a portion of the company. So here's what stockholders can do. And this is called again, we're still talking characteristics of a corporation. Stockholders have what we call a limited liability. In other words, if the corporation itself does something wrong, the stockholders are only limited to the amount of loss that they've invested. So if you've only bought $10 worth of a company share and something goes bad with that company, you're only subject to a loss of $10. Okay, so I don't test on this type of material, but I do want you to understand what happens. When you buy stock, you are the stockholder. You, the stockholder, gets to vote the board of directors in. And these people pick the officers, the president, the VP, the treasurer, and then these people choose employees. So you're up here, the only real thing that you really get to do is you get to vote in your board of directors. Again, that is a whole separate section of lecture that we're not going to get into. So let's talk about advantages and disadvantages of a corporation. Now this again is just for your purpose and your knowledge. I'm not going to test on this material, but it's important to know because one day you might actually own a company and you want to know about that. So the biggest advantage of a corporation is it's separate from its owners. In other words, if something were to happen to the owner, if they were to be sued, the corporation is not subject to being sued. The corporation is going to continue no matter what happens to the actual owners or the stockholders. And as a corporation, you actually have the ability to generate more capital. Okay, here's the biggest disadvantages. Let's talk about the disadvantages. The biggest disadvantage in my book is it's double taxation of dividends. Basically, it's double taxation. You own a company and you work for it. Obviously, you get a paycheck. You're going to pay taxes on the money the corporation makes. You, as the owner and an employee, will also pay taxes on the money you take to pay yourself. So it's called double taxation. So these are just advantages and disadvantages of a corporation. If you've taken Intro to Business, you've already covered this. Okay? So we're going to talk about how to form a corporation. Again, this is not test material in my classes. When you actually want to form a corporation, you have to file an application of incorporation within the state you plan on doing it. And each state is different. And I'm going to tell you right now, we're in California. California is not the easiest state to do business with. So here's a list of some companies and the states they've incorporated in. So notice how many have incorporated in Delaware. And these are big companies that you are familiar with. But look at where the headquarters are. Not one of them are in Delaware, but yet they incorporated in Delaware. That's because Delaware is one of the smallest states there is, and it's the most friendly business state. It encourages and allows businesses to incorporate in the state of Delaware because they will get tax dollars for that. So they're the most business friendly state there is. Okay? So after you file your articles of or application for articles of incorporation, you're going to get something called, the state will grant you, a charter or articles of incorporation. And then you're going to set up bylaws. So really it's a paper process. You fill out an application to the state approves it, sends it back to you. You have what we call an article of incorporation or a charter of incorporation. Then you as the management of the company have to set up bylaws and do certain rules and procedures. And all that will be given to you when you set up your articles of incorporation. So here's the key. The whole chapter is about cost. What do I do with the cost that I incur when I'm setting up my incorporation? So all of these fees might actually happen. These are called organizational expenses. Okay? So when I pay money out to incorporate, yes, there's a fee to incorporate. Taxes, legal fees, all of these are called organizational expenses. And so they're going to be journalized as such. So here's a journal entry for if I paid a total of $8,500 out. This is exactly what I expect to journalize for my organizational expenses. Okay, so we're going to move on to actually talking about the corporation. We need to talk about what we call paid-in capital from stock. Okay, so the main source of paid-in capital is contributed capital. By the way, there's two sources of equity. Under stockholders' equity on the balance sheet, you're going to have paid-in capital and retained earnings. Now, we have covered retained earnings in depth already. Well, the main source of paid-in capital is when I issue stock. So I'm going to continue on. You know what? No, I'm going to stop here. And in my next video, we'll talk about the different characteristics of stock. I don't want my videos to be too long. I want them to be short. You can understand them. So this will be the end of this video. The next one will be characteristics of stock.